Welcome to the daily update, where I'll go over the action in the market for Thursday, April 25th, and then we'll see how things look for Friday, April 26th. We saw a really negative open, and it looked like, oh boy, here we go. Now we're already negative in the short and intermediate term, and it looked like, okay, we're just going to build upon that. But the market showed real resilience. We ended up finding support at about the 5,000 level, and then spent the rest of the day, for the most part, coming back. And so we're still shifting a little bit more towards the positive side. We haven't switched positive yet. However, that could change on Friday depending on the follow through. Right before I started recording, I noticed that the S&P futures are up 0.85%. This is on the heels of Google and Microsoft reporting earnings. Now, Intel earnings, they weren't taken very well, but the big boys now, Intel used to be a big boy in a stock that I followed very closely, but now it's been replaced over the years by other companies. But Microsoft, Google, Nvidia, companies like that, we could see a nice little bounce on Friday. Now, the thing to watch out for is we may see a gap higher open. Now, this is still a number of hours before the market even opens as I record this, so anything can still happen. We also have a major inflation report coming out with core PCE. Kind of freaked out the markets a little bit on Thursday of the GDP and then the inflation component inside that, which I'll go through. We'll have to see what follows through with the core PCE report on Friday. Is that going to look more friendly to the market? It did a month ago. And then right on the heels of that, we heard a speech on Good Friday by Jerome Powell that seemed to kind of confirm that everything was fine. Then it was after that when things started to shift. What's the PCE core going to do this time? All right, let's go through, talk about a few things, and then I'll go through the charts. Right at the open, we did have a gap lower open, not really surprising. Tesla came out with some earnings that were just not well accepted after that, but they went up. Then after that, we had, okay, I'm drawing a blank here. Meta. Yeah, there we go. Meta, which they had a really good report, but didn't really like what they said going forward. And so the stock just got hammered. That's why I don't do earnings plays, because you can have everything that humanly logically will support the idea that, okay, the stock should go up from here, and it just tanks. And then we look at Tesla's report where it should have gone down and it goes up. And see, it's a gamble. You're rolling the dice at that point. It's whatever mood the market gets into and latches on at any particular time. And so I tend to not get involved in those kinds of things. I like to deal with more logic that I can also transform over to human logic that I'm taking from market logic at the same time. But we did have a gap lower open. It looked like it was going to be just an ugly day. But we ended up finding support at about the 5,000 level. As the day went on, prices climbed back higher above S2 at 5,027. So, and then we just kept going up after that. We got above S1 at 5,049. And we broke back lower and looked like, oh boy, here we go. Later in the day, it looks like we're going to start heading lower. We did for a while, but then we ended up going back higher again to close at about S1. So when you look at it on a close to close basis, if you just use a line chart, it's kind of down a little bit. But what really spoke loudly was the action that happened inside the day. We start lower and then spent the rest of the day pretty much clawing our way back. So we were down 0.46% on above average volume. So volume has been picking up now. And we are still negative in the short and intermediate term, but showing some signs of improvement. But we need to see more follow through. And it's about inflation and interest rates. And I'll talk a little bit more about that. And we want to keep an eye on the geopolitical things going on, which are now also drifting over into the US as there's a lot of protests going on across the country. That usually doesn't have an impact on the markets, but it can have a real impact on pop news and the current news cycle and what everybody's talking about these days. And people get fixated on that for a while until it's replaced by something else. Some comments that we can make. After hours, the S&P futures are really up after Google and Microsoft reported their earnings. Oil did go up. to $84.73. But again, this appears to be more due to market forces, not so much due to unrest that's happening. We're still extreme negative with our slope oscillator. And even though our oscillators are showing some improvement, they're still negative, all taken all together. And I have the slope oscillator here because it's our touchiest oscillator. Also in the intermediate term, these are mainly momentum-based oscillators here, where we have the TTM squeeze, the ease of movement, and the chicken money flow. Now, the bullish percent index, that's calculated in a different way. That's not more momentum. That's trying to measure point and figure buy or sell signals inside the NASDAQ 100. It's still extreme negative. But these other ones showing some improvement, but still negative. But in the long term, our 150 and 200 period simple moving averages, they are still extreme positive, which we can still latch on to for the backdrop to say, okay, the long term is still looking pretty good. And then we're wondering, is something going to happen this week to change this scenario? It's already been modified a little bit. It was looking like the Fed was done raising rates. That seems to be in doubt now. But it also looks like the rate cuts that the market was anticipating, those are also in doubt now as well. And we'll see if Friday sheds any light on that. And then I'll kind of fall back and regroup and see if this scenario needs to be adjusted. The dollar was up and interest rates were also higher. This also pressured stocks. We ended up getting above 4.7 for the 10-year yield. We closed at 4.71%, where we had been at 4.65%. We're still inverted with the yield curves. Sentiment didn't really move all that much. We had been at 41. We ticked down to 40. Our trend is still negative. The red line is still on top. The ADX is still above its moving average, showing that the trend is strengthening. Our bias is negative with the down day, and I'm still keeping our momentum at mixed for right now. We have the potential of being positive on Friday. We've been showing some improvement, but we're also coming out of a period of time later from last week where things were quite negative, decidedly negative. Economic reports that came out. Some of these, I'm just going to go through the numbers. We had advanced international trade in goods. It was at a minus 91.8 billion, more than the 90.3 billion we saw last time. Retail inventories they were less than expected, or less than last time, up 0.3%. Last time they were up 0.5%. Wholesale inventories were down 0.4%. Last time they were up 0.4%. Then from this point on is where I'll start to show some charts after this. We had a weekly initial jobless claims. They didn't come in at 212,000 again. That's kind of interesting. But they're still not all that bad. They actually declined. They expected them to come in at 215,000. They came in at 207,000. Last time we did see that infamous 212,000 number. Continuing claims are also declining. They were at 1.781 million, down from the 1.796 million that we saw. And here's the one that was really causing some words to fly back and forth, specifically stagflation. Now, we don't know. It's going to take some while for this to play out. And if everybody's latching onto the stagflation scenario right now, it's very premature at this point. Stagflation is where you have very, very high inflation and really little to no economic growth. And we could develop into that, but to try to come to a conclusion right now, we need to see this played out longer. But the advanced GDP came in weaker than expected, and that freaked out the market. They expected it to come in at 2.4%. It came in at 1.6%. Notice that it's still positive, though. So we have positive GDP for right now. Then last time it came in at 3.4%. So this was a real significant decline from what we saw. The deflator, and this is the inflation part, it came in stronger than expected at 3.1%. They expected it to be at 2.9% and up quite a bit from last time where we saw 1.6%. So they're seeing inflation in GDP and diminished growth, and that's where this massive stagflation idea comes from. And like I said, it could develop into that, but we need to see this story unfold to get more evidence over time. Pending home sales were a lot stronger than expected, coming in up 3.4%. They expected them to be up 1%. Last time they were up 1.6%. Here's some charts. Here's the weekly jobless claims where we did drop off down below this 212,000 here, and the moving average is going down. This is suggesting strength in the employment. And the continuing claims are also declining. We're seeing the moving average start to go down just a little bit. So when we take this all together in our longer term chart, the blue line, these are continuous claims, which declined. We have the most recent reading of unemployment, which is at 3.8%. And then the red line are continuing claims. And the red line are initial claims, where that also saw a little decline. This shows you a little bit more blown up, make it a little easier to read, just to give you some context there. And here's the real GDP and the deflator quarter over quarter, where the blue line, this is the GDP, and then the deflator is the yellow line. We saw the blue line going down and the yellow line going up. And that's what's causing a lot of concern right now. And we have personal consumption, which did drop off just a little bit on a year-over-year basis. The net exports are going up, but they're still negative. We still take in more things from overseas than what we send out. And real GDP on a year-over-year basis, it is declining a little bit, but it's still positive overall. And then the pending home sales. This is only the second time in the last 4 months that we've seen pending home sales actually positive on a year-over-year basis. They had been negative, but showing a sign of improvement. Now we're finally starting to see that change a little bit. And this is the month-over-month reading, where we are seeing a real increase and some improvement in that area. Here's some blog charts. The Magnificent Seven, they're expensive when you compare it to the rest of the index. This is the trailing PE, so this is looking back against the S&P 500, just showing that right here in the middle, this is the average. And this is showing that the magnificent stocks are expensive. Now, at the same time, first of all, the market looks forward at forward PE ratios. And a lot of folks are okay with having these companies with higher PE ratios. They're willing to spend the money to buy their stock now with the hope of future earnings being much better than they are right now. So I wouldn't really take this as a real warning sign, but we just want to be aware of these things at the same time. And I don't know why they brought this one up for Isabel Net again. This is short interest. I just showed this a couple of days ago, that it's still quite low overall. And when we get up into the 2%, 3% area, that's when short interest gets a lot higher. This is when investors actually go in and directly short the S&P 500. Now, there's other alternatives that we have available to take advantage of downward movement now. There's inverse mutual funds, there's put options, there are inverse ETFs, there's even inverse juiced ETFs. So let's say the S&P goes down 1%, and one of these juiced inverse ETFs, it could go down 3% with the same move. Unfortunately, that can also work against you. And you got these people that all they look at is what they're able to make, not necessarily focused on what they're able to lose through getting into these kind of vehicles. But there's a lot more risk when you directly short the S&P 500. There's a whole different set of criteria and requirements that you have to live up to, where if prices go against you, you have to get out. Where some of these mutual funds and ETFs, if you don't buy them on margin, you can just ride them out. Now, they may go to zero, but you're not being forced out because of requirements. Then looking at Bitcoin now versus gold in the 1970s, if some of you were around in the 70s, this is when gold really started to take off. Back in the mid to late 70s, there was a lot of political unrest. And my gosh, it's looking like 1968 right now in the US, if you're much of a student of history. And I do teach history, so I really keep up on this stuff. But as things were really developing in the early to mid 70s, we had the Yom Kippur War. We had a real problem with the current administration where President Nixon had to end up resigning. And so there was a lot of real uncertainty going on. And so you really saw gold going up during that time, which gold is in its simplest form is known as an inflation against insanity. And it looked like things were going insane at that time. Well, they're trying to match this up with what's going on with Bitcoin. Is that now the new gold that's going to be coming in? Some people would agree with that. Other people disagree with it. But gold has been holding on to its own pretty good lately as well. Then we say we expect continued disinflation towards the target. Okay, so now this is put out by Goldman Sachs, and they think going forward from here, that inflation is going to continue to drop until we get to that 2% that the Fed is anticipating. Now, this is before the GDP report came out, and it's before the PCE report comes out. So we'll see if they end up having to make any adjustments to this. CEO confidence is showing a little bit of improvement. In yesterday's video, I talked about small businesses having not very much confidence. These are bigger companies that have CEOs where they're looking a little more positive going forward from here. Then this is what are investors anticipating as far as rate cuts in 2024? Remember, back to the beginning of the year, they were looking at 6, possibly 7 rate cuts. Now they're down to thinking we're going to get 2. And then there's still a pretty good crowd thinking we're going to get 3. There's a little bit less thinking we'll get 1. There's 8% thinking we're not going to get any cuts. Now, this could change, especially if the PCE report coming out on Friday reflects more of what we saw on Thursday with GDP. And then 4 rate cuts, and then more than 4. You always get these people. There's 10 rate cuts that are going to happen here. And so far, none of them have actually come to pass. Then looking at U.S. public debt and the price of gold, where these have a kind of a tendency to go in the same general direction. And that's another hedge that gold is used for, is to guard against a lot of government debt. And then some Twitter charts. This is really interesting. You've got JP Morgan, okay, this is one company. And you got this one genius up here that says that the S&P is ripe for further gains. Well, then somebody in the same company says, no, we still have more to go before this is over. So they can't even agree within a company what's going to happen with the market. So that's why I come to my own conclusions. That's why I look at lots of charts and as much information as I can. And I listen to what other people say, but I ultimately reach my own conclusion. And that's what I try to teach folks in my program. Critical thinking, how to come to a conclusion yourself and not just have to be a sheep that follows other people, because you eventually you get slaughtered when that happens. Then looking at the change in liquidity, I showed this chart about a week ago, and we're really seeing this dropping off, and that could be part of the reason why we're seeing some pressure in the markets as of late. There's our cycles, wondering kind of where we're at now. We're coming up more into the latter part of April. Maybe we'll see a bit of a bounce coming here. We could still see some more weakness as well. So here's our intraday chart where we had a massive gap lower. We didn't get down to S3. That was down below current prices. We were able to establish some kind of a base here right at about 5,000 and then spent the day just clawing our way back up. We did try to get back above S1, saw a little bit of weakness, but then quickly went back above S1 again, fell, and then closed right about at S1. So taken by itself, this looks fairly constructive to have such a lower open and then to spend the rest of the day clawing its way back. We'll have to see if we can get any follow through. Now, it looks like we may gap higher on Friday. Is that going to bring in selling? Are they going to sell into strength? Here, it looked like they were buying into weakness. Here's our intraday chart, where really the takeaway from this is over the last couple of days, the biggest part of the market move has been right after the market closes, where after Wednesday, we saw a real gap down with the Facebook earnings that carried over into the session. Well, now we're seeing a real gap up after Google and Microsoft reported, and we just saw where things got weak and then ended up stronger. Are they going to start stronger and then get more weak as Friday unfolds? We don't know that yet. Just something to keep in mind. We're still seeing where value is outperforming growth. The red line is still above the blue line. We didn't see a further breakdown with growth to value, but we didn't see a big improvement either. So we were still negative with the growth to value ratio intraday for the S&P, but it ended up closing negative after it had been trying to show some improvement here. And then our end of day charts, we were down more with growth versus value with the large caps, down less with the mid caps, and also down quite a bit less with the small caps. So our end of day charts, we saw a little bit of a tick up with the small cap growth to value ratio. We were pretty much flat with the mid caps and a little bit of a tick up here with the growth to value ratio for the S&P, but still not coming back and repairing this damage that we've seen lately. This is still holding up for right now. We look at growth versus value. We came down to this 250 period moving average, and we're bouncing up off of that. Now, we did decline a little bit on Thursday, and we'll have to see, is this going to be able to continue to go back up into the rainbow or eventually fall down below the rainbow? We saw a little bit of an improvement with discretionary to staples in the ratio down here at the bottom, where we're bouncing off the 200-day moving average. Large cap growth, it started out right back at its 100-day moving average, but then was able to come back and close near the high for the session. So that shows some promise there. The Wilshire was down about 0.5%, but it closed well off of its lows as well. Looking at our trend, we're still negative, where we have the ADX turning up a little bit compared to the moving average. That suggests a strengthening trend, and the red line is on top, and now the red line is starting to go back up. So we still default to the negative trend until that ends up changing. We're also seeing this a little more pronounced here with the short-term ADX, where it's above the moving average and the red line is on top. We did pick up, and we've seen a couple of days now of above average volume. So that's showing there's a little more conviction to what's going on. We did get the latest reading from Investors Intelligence, where there was a big drop-off as expected. They came in at 2.15, where we had been just under 4 lately. And so this is showing that a lot of the folks that put out newsletters and try to make suggestions for folks what they should do, they've turned back more to neutral after being very bullish on things. The Ulcer Index is continuing to show that fear is pretty high. We actually ticked down a little bit on a closing basis with the VIX, and we had a pretty wide bar here where we closed pretty much at the low for the session. So the VIX is coming down as the market was showing improvement throughout the day. We're still below the moving average when we look at the line chart on the bottom, and we started off by seeing the volatility was really picking up, but then it really dropped off as we got closer to the close. So the momentum for the VIX is now switched to down, where we were really spiking up with the VIX. Now, for the most part, it is heading lower on a momentum basis. The equity put call ratio turned down on a down day. So that's kind of interesting. And we're continuing to decline with the 5-period equity put call ratio. This is more positive for the market. We're also dropping off with volatility risk premium. We're just coming down more to the lower end of this band. We turned up a little bit with this fear gauge, but we continue to go down with this other fear gauge. So we're still getting a little mixed signals with some of the other charts that we look at. And the risk on versus risk off ratio, it was virtually unchanged on the day. We'll have to see if we can keep using this as any kind of an indicator. We did get the latest reading from the American Association of Individual Investors. They've actually dropped to negative in the latest reading, but the moving average continues to go up. Our advanced decline line studies turned down a little bit based on price and volume. We've been kind of hanging on to this. We'll see if it can show some follow through positive action in Friday's session, or if it's going to turn more negative. We're still looking good here. We saw more new highs than new lows being generated when we look at the raw score. So now we're starting to turn positive with our 5-period and our 10-period. So this internal measure is continuing to show some improvement. And even though we declined, we're still above 0 with our advanced decline ratio. Accumulation distribution, this actually is showing some improvement. We're coming back up to the moving average. We're pretty much right on top of it now. But this is volume-based, and it's supposed to be a smart money indicator. So if we can get this above the moving average and see a little bit more of an uptrend, that would really turn things more positive. You can see how we were above this moving average as we were climbing from November all the way into about the middle part of March. And the Chaikin money flow, still negative, but starting to bounce up after giving us an extreme negative reading. So this is showing some improvement as well. This is also supposed to be a smart money indicator, and we're actually turning positive with the Chaikin oscillator. We're just barely above the midpoint here. And we turned down a little bit with the NYSE cumulative advanced decline line. We also declined a little bit with the NYSE advanced decline line and came down with our other NYSE advanced decline line, we're right back down to the moving average. And then when we look at the NYSE common stock based on price, we did decline where we fell just a little bit less based on volume. That's another thing that we're watching right now. Volume seems to be leading price a little bit positive. And when we have a down day, it seems to be lagging behind. Now, I was following that a few weeks back, and it really didn't materialize into anything. So it's just an observation that we want to make that could feed into things turning more positive. We're still just barely above zero with our NYSE new highs minus the new lows, but we did drop off. And we're ticking down a little bit with the S&P 500 cumulative advanced decline line based on price, but we're still going up based on volume. This is another one of those things where volume is starting to outperform price. So we came back down a little bit with our advanced decline line studies when looking at the NYSE common stock. We're back down to the moving average at the S&P, the mid caps, and we actually declined with the small caps. So on a short-term basis, we came down to this pivot point, which acted as support, which was right around the 5,000 level, and we were able to bounce up off of that. Now, if we start to see some follow-through strength, there is a pivot point, and we do have the 50-day moving average, and we also got those 20-period moving averages still above current price, which may end up providing some overhead resistance. Down below, we are above average again with volume. And this is what we want to keep an eye on. We're still below the 20-period moving averages. We came close to the exponential moving average. That's blue. It would be more positive if we could get not only above the blue, but eventually above the red. This would be the short term turning more positive. But when we look at our double and triple exponential moving average study based on 20 periods, we're still kind of dancing around in the middle part in between these two lines. And we're flattened out with our 20-period moving average study. We turned down slightly with the 50, and we declined a little bit with the 200. This is another area of hope that we've been hanging on to that was looking positive even as the S&P was going down. It did show a little bit of weakness on Thursday, and we're ticking back down. We were also seeing some improvement here with the force index. We were negative, but getting closer to zero. We declined a little bit on Thursday. And we turned down a little bit with our short-term stochastic. And we're still continuing to go up with our intermediate short-term stochastic. And we're no longer extreme negative with our long short-term stochastic. So longer term, we're still seeing some improvement. Shorter term, we're seeing some weakness. And I like to explain this. The reason I say it the way I do is this is a further subdivision of the short-term time frame. We were able to get back up into the -1 channel with our standard deviations chart. We started off being in the -2, but clawed our way back to -1, but we're still below the midpoint. We want to be able to get above that midpoint and see the midpoint turn up to turn more positive. When we look at the balance of power, it ticked down and is still negative. The go, no go, is still showing us a lighter shade of purple. So it's negative, but kind of still a positive slant to it. We're still up off the lowest low value, which is the red line, but we're continuing to be below the midpoint with this chart. And the TTM squeeze continues to show some improvement. We have the lighter shade of red, and this is starting to come back up. It's still negative, though. There's a longer-term look at that same chart to give you some perspective. And we're dealing with the 50-period moving averages. We came right up to the exponential moving average. Well, we fell down below that. We're still below it now. Can we recapture that possibly on Friday and then eventually get back to the simple moving average? We're still above the 100-period moving averages. This acted as support, and we've been able to bounce up off of that. Can we continue to bounce up off of that? The ease of movement did tick down. It had become extreme negative, was showing some improvement, but then we saw some weakness on Thursday. The Erin is just like, what? Something happened? Where we're still seeing a decline of sellers. That's the red line, a decline in buyers. So our oscillator, it's negative because it's below zero, but it is flatlining right now. And after just barely getting above zero with the S&P McClellan oscillator, now we dropped below zero. So that's turning more negative. So we're pretty much flat now with the summation index based on price, but we're still going up based on volume. Remember, these are two completely independent indicators from each other. They're calculated completely different. I just put them on the same chart. Now, be aware, this has also led us astray before, but this has also given us some heads up that things could be turning more positive. We had been able to come back above zero with the NYSE McClellan oscillator. Now we dropped back below zero. So we're continuing to decline based on price and volume after we were seeing just some slight improvement there with the summation index for the NYSE. But the Swenlin trading oscillator, man, it's just boogieing higher, both based on price and volume. But on a momentum basis, we're still going down with the PMO. We're turning up based on price and volume, but we're still below the moving averages. We turned down just a little bit with the PMOs that are rising. We're still going up with the buy signals. We are flat to slightly declining with the PMOs above zero. And we continue to be neutral with the Elder's Impulse system for the S&P. We still have another dot. Even now, I don't know where it would have ended up had we closed lower, but because we were able to close near the high for the day, that gave us another dot with the parabolic SAR. So that's turning the intermediate term potentially back more positive. The slope oscillator is turning up, but still below its moving average and giving us an extreme negative reading. The MACD is trying to turn up, it's still below the moving average and still below zero. So we're seeing some improvement in the short term with our oscillators, trying to turn up in the intermediate term, but still, for the most part, headed lower with our longer term oscillators. We want to watch these moving averages here. They may act as support if we fall. They may act as resistance if we continue to go up. We're still above 50, though, with the bullish percent index. Even with the down open, we didn't see a lot of point and figure sell signals being triggered. So that's positive. So this is actually looking a little bit better than it has been over the last few days. This was one of the holdouts, and this is an indicator that I really like because it's not moving average based. It measures the point and figure buy or sell signals. And even with the down open, we didn't see a lot of new sell signals being triggered. In fact, this actually showed a tiny bit of improvement. And we're still looking okay with the NYSE bullish percent index, where it's still above 50. And we're pretty much flat here with the NASDAQ 100 bullish percent index, and we're still extreme negative here. The money flow did turn down, but it's below 50 and now declining. So that's negative. We're still going up with the ultimate oscillator, but it's still below 50. And the vortex is flattening out a little bit with the red line where the green line is going down, but we still default to negative here because the red line is on top. We turned down a little bit with our RSI based on 14 periods and 9 periods, and we're below 50. You notice for most of really since the big upward move last November, we spent most of the time above 50. Now we're starting to spend more time below 50 as the market has really been showing some weakness. We're still below the moving average with the on-balance volume. We're still showing some improvement here with our 20-period moving average study. We did come up just a little bit. We're still negative since we're below 50, but this is continuing to climb. We were actually down with our 50-period moving average study and below 50, so that's negative. We turned down a little bit with the 100 period as well as the 200 period. So shorter term, things are looking better. We're not seeing that following through into the intermediate and long term, at least yet. We are turning up with the Copic curve, but we're still negative. We did turn down with the Sean trend meter. And we're keeping an eye on Ichimoku cloud. It looked like that was lining up with the 100 period moving average study for the S&P and then some support that we saw in the mid caps. And so far, we've been able to stay above the lower end of this cloud, which may be providing support. We're really trailing off with standard deviation as price has been chopping sideways for the last few days. We're coming back down to the moving average. So we're looking a little more negative with the Heiken Ashi. We have a dark candle. We're still pointing down and negative with the Kigi chart. The Renko chart is still negative. The 3-line break is actually still looking more positive. Long term, we're going to really see if we get an upward thrust in Friday's session, are we going to be able to get above and then stay above that 51.10 to 51.11 level? We're still looking okay, even though we declined a little bit with our 150 and 200 period moving averages. This is suggesting that the long-term trend is still staying quite positive. And then we're still negative in the short term when we look at all the different indexes based on stock. We're also continuing to be negative in the intermediate term with the Russell, the small caps. We're still negative across the board with bonds based on price. No changes here in the decision point scorecard. Negative in the short term, positive in the intermediate term, and mixed in the long term. And we started off seeing some, well, this is actually it depends on how you look at it. Right after the open, we saw a bullish MACD crossover for the financial sector, which has been showing some improvement. But then later on, you see where the BPI crossed below 70. So there was something good that happened, and then later on, something negative that happened. The euro against the dollar was showing some strength, but the dollar's been holding up for the most part. And then we saw an awful lot of negative things here. With the S&P going below 5,000, we had the bullish percent index now drop below 50, which is what I just showed you. We're seeing materials which had dropped below 50. Now they crossed back above 50. And the utilities are seeing some recent strength too, going above 50 with a BPI. And then the Dow, right near the end of the day, saw a MACD positive crossover. So not really seeing a big difference right now between the S&P weighted index and the equal weight index. We were down about 0.25% as the broad market held up a little bit better than the mid caps. The Dow, which had been looking a little more positive, it gapped lower, but again, closed kind of near the high for the day and above this pivot point. So it's showing some resiliency as well. We've gone from being positive over to neutral with the Elder's Impulse system for the diamonds. And then this is another look here. We opened lower with the NASDAQ and then closed just a little bit above this pivot point near the high for the day. NASDAQ 100, kind of the same thing. We opened at the low and then closed just a little bit below this pivot point near the high of the day. But we continue to be neutral with the QQQs when looking at the Elder's Impulse system. The momentum for the NASDAQ 100 continues to be negative, even though it's trying to turn up. And we are seeing this 2050 cross here. That's a negative cross. But the bar itself looks pretty good to open near the low, to close near the high, and show some real resiliency. At least the market's not rolling over and playing dead, at least yet. Small caps, they were down, coming down a little bit further into the lower end of the range that they've been in. They continue to be neutral with the Elder's Impulse system for the small caps. But this is actually positive. When we look at the Russell 2000, where we've been dealing with this resistance/support level, well, we broke down below it, but we were able to get back above it in Thursday's session. So this support has not been lost, at least yet. Even though we did decline with the RSI, we're still on a longer-term uptrend. The momentum is trying to improve, but it's still negative. The mid caps, which we did, at least I'm pointing this out as possible support. We bounced off of this pivot point here. It did see some weakness. It was down almost 0.5%, but it also closed near the high for the session. And we switched from being positive over to neutral with the Elder's Impulse system for the small caps. Apple was up over 0.5%, but is still below its 50-day moving average and still in a downtrend. Tesla, came out with a weak earnings report, and then it was up another 5%. Go figure. But still in a downtrend and still below its 50-day moving average. NVIDIA trying to come back up to its 50-day moving average, but it's still below. Microsoft actually gapped lower, but closed near the high. Now it's probably going to see a nice little upthrust at the open on Friday with the earnings that came out. Meta, which came out with a good earnings report, but they didn't like some of the things that were said. It gapped lower, but it also closed near the high for the day. It was much lower when it initially opened. And I know I don't watch the financial media and I don't really pay attention to that stuff, but I'm sure there were reports out there saying, yeah, Zuckerberg has, $100 billion wiped off of his net worth today. They just love to do things like that because it's easy to calculate and easy to poke fun at folks. Amazon, which is also coming out with earnings, it closed right at about the high for the session, but it's still below its 50-day moving average, but it could show some strength in Friday's session. Google also closed near the high for the session. It didn't set a new all-time high, but it showed a nice little bounce as well. The FANG index also opened a lot lower, but closed near the high for the session, but we're still below the 50-day moving average. The financial sector is still holding up, even though it was down 0.58%. It's coming back down slightly to its 50-day moving average. We want to keep an eye on this. The staples to tech ratio, when this is going down, that means staples are underperforming. If that starts to outperform like it did in 2022, that means the market's getting more defensive and that tech is under pressure. With this going down, that means that tech is doing better and staples are under pressure. We saw a recent bounce up to this 200-day moving average. Now, it has been falling back a little bit, but we just want to keep an eye on this if the market is turning over and being a little bit more defensive. The dollar ended up being up, but we're still not back up into the 106 range here. Oil was also up to $83.57. I think was that a 57? Yeah. And then also be reminded that there's a 1-day lag with this MSCI World Index. We're dropping off a little bit with the 10-day correlation. We're pretty much flat to still declining with our 50-period correlation. We were down a little less than 0.5% with the total stock ETF, and we're still below the 50-day moving average. And keeping an eye on interest rates, we're up at the 4.7 level. We're wondering, are we going to go back and tackle this 5% level again? Well, we seem to be kind of inching our way in that direction right now. So we were down with the 10-year based on price. And then looking at our growth to value ratios, we're seeing a little bit of an improvement here, but not much. With the Qs still underperforming the S&P, saw a little bit of a bounce up to the moving average with discretionary to the S&P, but still below a declining moving average. And not much of an improvement when we look at large cap growth versus large cap value. So with the large caps, mid caps, and small caps, not really seeing any market improvement there. We're still above 50 here with our 10-day average of the S&P 500 highs minus the lows. If you've been watching these videos for a while, we were camped out in extreme positive territory for pretty much all of 2024. Then we started to fall. Now we're coming back and looking a little more positive here. We're still above zero when we look at the 19-day exponential moving average of the advanced decline ratio based on price and volume. And we're still positive when we look at the 50-period moving average of the new highs and new lows for the S&P. But we're still negative when we look at the 5-period moving average of the highs minus the lows for the broad market. And this is a little concerning, where we're seeing the S&P to utilities ratio going down, even though it ticked up just a little bit here. But when this is going up, that tends to do better for the S&P. When this is going down, that puts pressure on the S&P. And we're also watching the Staples S&P 500 ratio. It's coming down a little bit, but it has been really spiking up lately. We have not seen a ZWAG NYSE breadth thrust. If we see a monster up day on Friday, it'll be interesting. Now, we're not going to know this until Monday or Tuesday, if this has even been triggered. We're still in that window where we had an extreme negative reading. And then if we can get up above the red line to give us an extreme positive reading within 10 trading days, that would be the third ZWAG NYSE breadth thrust that we've seen triggered in a little over a year. These are very rare in and of themselves. To see 3 of them triggered so closely to each other would be even, like I said the other day, the cow is still walking through the room. It's so rare. So what's our outlook for Friday? A lot of earnings coming out this week. Microsoft, Meta, Tesla, Alphabet, about 40% of the S&P will end up reporting by the time we're finished with the week. We're still negative in the short and intermediate term, but we are seeing signs of improvement. We will get personal income and spending and also as with the core PCE prices, the final reading for consumer sentiment. We want to keep an eye on all the crazy things going on around, because sometimes that can bleed in and actually have an effect on the market. And then we're pretty much finishing out the economic calendar. These are the previous readings for the core PCE that the market will be latching onto here. Seasonally, where we're positive with the Dow for April 26, we're neutral to positive with the S&P, we're neutral to negative with the NASDAQ. So not really getting anything there. We are going to be finishing out the week after options expiration, where we tend to be up 64% of the time and down 36% of the time. We do see a little bit of positive bias here with the green dashed line during an election year, and this will be the 20th trading day of the month. And then the weakness that we're seeing, we're actually bouncing up from this. This chart is a few days old now. We possibly could be trying to work our way back to the average of what has happened in the past. Also trying to get back up to when we compare it to the top first quarter during an election year. Friday tends to be one of the more positive days of the week. Not as positive as Monday, but it's the next most positive day. We're also starting to finish out April, where we tend to see some strength. And this is what I alluded to yesterday, and I'm still just keeping this in the back of my mind. The more defensive nature that we've been seeing in the market, could that be because We have a good solid finish usually to the end of April, but then we don't see any big declines in May, but we don't see any real advances either. Could this be the smart money just getting ready to ride that out? Now, that may not even be possible, but we just want to be thinking about that. Maybe they're getting into the more defensive areas like staples and things like that, because they know that we're going to enter a period of weak seasonality. And then at the end of May, then that's when tech really starts to do well, at least going into the early part of October. And then we might see more of a repositioning as we get into the latter part of May. Pure speculation on my part. As I said in yesterday's video, I haven't heard anybody talk about this. This is just an idea that I came up with myself, where we do see some weakness going into the first half of May. And now we're in the more positive time of April, according to Tom Bowley's research. And we are positive on a percentage basis in May during election years, up 13 out of 18 times, down 5 out of 18 times. But the return is very minuscule. And maybe the smart money is getting ready for that. So our warning signs. We have crossed back over to being negative with the S&P and NYSE McClellan oscillators, where they had switched over to positive. The bullish percent index for the NASDAQ 100 is still extreme negative, but trying to show a little bit of a bounce there. The Chaikin money flow is extreme negative, but also bouncing. The ultimate oscillator is negative. The Copic curve is negative. The vortex is negative. Our oscillators are still showing that momentum is negative, even though they're trying to show some improvement. We're still negative on a short, intermediate, and long term when we look at different points. The short term, that's the 20-period moving average that I'm focusing on. Intermediate term is the 50-period moving average, and long term is that weekly chart of the pivot point, the 5110 to 5111 level. And we're still negative with the momentum for the NASDAQ 100. Positive signs. The Swenlin trading oscillator is still looking pretty solid. The parabolic SAR continues to be positive. We're above 50 with the bullish percent index for the S&P. The Chaikin oscillator is back to turning positive now. The long-term trend still remains positive. That's longer-term moving average based. And the equity put-call ratio is still going down. Financial sector, even though it pulled back on Thursday, is still looking okay for now. And we're waiting to see if another, and I never did change this NYSE here, we're waiting to see if another ZWAG NYSE breadth thrust will be triggered. We still have that window of time. Our conclusion, we're negative in the short term and intermediate term, but we could be seeing signs of improvement, even with a down day. To see the strength throughout Thursday's session was rather encouraging if you're bullish on the market. In the short term, we're negative, but showing an improvement. In the intermediate term, we're still below support. We still have some areas of concern there that are oversold, especially on a momentum basis, but we are bouncing, where we continue to be positive and even extreme positive in the long term with our 150 and 200 period moving averages. Thank you. I really hope you found this helpful. I hope you have a very good day. Friday looks to be an interesting day nonetheless, so we'll see how things play out, and I'll talk to you in the next video.